Will the stock market crash? Well, with the market continuing to march higher and setting record high after record high, I do worry more and more that a crash could be coming. It doesn't necessarily mean it'll happen tomorrow, next week, or maybe even this year, but I do believe the risk to reward of investing in the S&P 500 at this point is not favorable when you take all the data into consideration. I've talked a lot about the fact that the top 10 companies now account for nearly 40% of the entire index, and the forward PE multiple of around 22 times is well above the 30-year average of 17 times. But there are also less discussed factors that are quite concerning. There is something called the Buffett indicator that looks at the total US stock market value compared to US GDP. Buffett even made the claim at one point that this was the best single measure of where valuations stand at any given moment. The problem here is that it now exceeds 200%, which is a historic high and well above even the tech boom when it peaked around 150%. Another concerning measure is the Shiller PE ratio, which looks at the average inflation-adjusted earnings from the previous 10 years in relation to the price of the index. This is now at a multiple around 39 times, which is also well above the 30-year average of 28.3 and at a level that was only seen during the tech boom. While valuation isn't always the best indicator for what will happen in the next year, it has proven to be a successful tool for long-term investing. Unfortunately, though, valuations aren't my only concern. Margin expansion is even more frightening, as the reliance on debt can derail investors. Margin allows investors to buy stocks with debt, but the big problem is if there is a decline and a margin call comes, well, the investor would either have to add more cash or make sells, which causes a further decline in the stock due to added selling pressure. Well, margin debt has now topped $1 trillion, which is a record, and it has grown very quickly considering there was an 18% increase in margin usage from April to June. This was one of the fastest 2-month increases on record and rivals the 24.6% increase in December 1999 and the 20.3% increase in May 2007. In case you forgot, both those periods that followed did not end well for investors. Also, looking at margin as a share of GDP, it is now higher than during the dot-com bubble and near the all-time high that was reached in 2021. One other concern with margin is it does not include securities-based loans, which is another tool that leverages stock positions, and if there is a decline, could cause added selling pressure as well. Unfortunately, this data is not as easy to find since they are lumped in with consumer credit. The most recent estimate I could find was in Q1 2024, and they totaled $138 billion. And with the risk-on mentality that has occurred in the market, my assumption is the total would be even higher now. We have to remember that we now are essentially 18 years into a market that has always had a buy-the-dip mentality. Even pullbacks that occurred like in 2020 and 2022 saw rebounds take place quite quickly. This has created a generation of investors that have not actually experienced a difficult market. I always encourage people to study the tech boom and bust, as it was devastating for investors. The S&P 500 fell 49% in the fallout from the dot-com bubble, and it took about 7 years to recover. Investors in the NASDAQ fared even worse, as they saw a 79% drop, and it took 15 years to get back to those record levels. Unfortunately, this isn't the only historical period that saw difficult returns. If you look back to the start of 1964, the Dow was at 874, and by the end of 1981, it gained just 1 point to 875. This was an extremely difficult period that saw Vietnam War spending, stagflation, and oil shocks, but it again illustrates that difficult markets with little to no advancement can occur. So with all of this, how are we investing at this time? We are maintaining our value approach, which generally holds up much better in difficult markets. For comparison, the Russell 1000 Value Index was actually up 7% in 2000, while the Russell 1000 Growth Index fell 22.4% that year. We are also maintaining our highest cash position, mainly in money market, around 25%, since at least 2007. I continue to believe there are opportunities for investors. It just requires discipline and patience. One other person remaining patient at this time is Warren Buffett. Berkshire now has a record or near a record cash hoard of $344.1 billion, and the conglomerate has been a net seller of stocks for the 11th quarter in a row. I gotta say, I'd rather follow people like Buffett at times like this over the meme traders that have become popular once again. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for latest economic news, expert analysis, and market insights.